Ever wondered how to navigate Forex fees? In the world of Forex trading, these fees are more than just small print. They're integral to your trading strategy, and understanding them is key to maximizing your profits. We're talking about 3 types of fees here: spreads, commissions, and overnight financing. Each plays a unique role in the trading process, and each can impact your bottom line in different ways. Understanding these fees can make all the difference between profit and loss. First off, let's dive into spreads. Picture this: you're at your favorite foreign exchange counter. You notice the teller has 2 prices for every currency, one for buying, another for selling. That's essentially a spread, the difference between the ask price, what you pay to buy a currency pair, and the bid price, what you get when you sell. Now imagine you're buying euros with your US dollars. The teller says, it's $1.1 for a euro if you're buying, but if you're selling, it's 1.08. That difference of 3 cents, that's the spread, my friend. In the world of Forex trading, spreads are how brokers make their money. Each time you trade, you're paying that tiny difference. It might not seem like much, but it adds up. So hunt for brokers offering lower spreads. It'll save you some dough in the long run. Remember, a lower spread means less cost to you and more profit in your pocket. Next up, we have commissions. Imagine it like paying a cover charge to a club, only this club is the Forex market and the bouncer is your broker. Commissions are the fees you pay your broker for each trade you make. Some brokers charge a fixed commission per trade. Let's say your broker charges a $10 commission per trade. You buy 1 lot of EUR/USD and sell it for a $20 profit. Sounds good, right? But hold your horses. Take away that $10 commission and you're left with only half of your initial profit. It's like buying a $10 ticket to a concert, only to find out that half the band didn't show up. So before you start trading, ask yourself, can I afford to pay this commission? It's a simple question, but it can make a huge difference in your trading journey. Always keep an eye on commissions. They can sneak up on you if you're not careful. Finally, let's tackle overnight financing. Imagine you're a trader who leaves positions open when the market closes. You're essentially borrowing from the broker, and like any loan, it's not free. That's where overnight financing, also known as a swap fee, comes into play. This fee is the interest paid or earned for holding a position overnight. It's based on the difference between the interest rates of the 2 currencies in a pair. For instance, if you're trading the euro against the dollar and the euro has a higher interest rate, you earn the difference if you bought the euro and pay the difference if you sold. So being aware of the interest rates can significantly influence your trading strategy. Leaving a position open overnight could either earn you money or cost you, depending on the direction of your trade and the interest rate differential. Overnight financing can be a double-edged sword, beneficial when you're in profit but costly when you're not. Now that you've got the lowdown on Forex fees, it's time to take the reins. Embrace the opportunity to leverage your knowledge for financial growth. Remember, successful trading isn't just about spotting trends, it's also about understanding and navigating fees. And when you're ready to take your trading to the next level, CocoShell.com is your go-to resource for expert advisors for automated Forex trading in MetaTrader 4. Take control of your trading future. Start with understanding your fees, and remember, CocoShell.com is here to help you every step of the way.